Dividend Explorer here. Today it's day 6 of our investment plan, and we are going to invest in a new stock. Before we continue, please subscribe to my channel, hit the bell button so I can keep you up to date about my dividend exploring journey. Once again, it was a crazy day on the markets with crude oil prices dropping more than 40%. But before I explain you my next move, I want to tell you about my thoughts this weekend and how I changed my screener. The screener is the basis of my investment plan. It tries to look for dividend yielding stocks. The goal is to build out a portfolio that generates a safe dividend income every month. The plan has been inspired by the Ultimate Dividend Playbook. You can find the link in the description of the video if you would like to buy the book. And I used the ideas to refine my screener. Well, it was the inspiration in the first place, but after the first week, I decided to tweak a little because I was feeling the screener was generating unsafe dividend stock. The full screener and our buy list for April 2020 can be found on dividendexplorer.com. And as you can see, the second one on the list was Pembina because of the high yield and the great debt to equity ratio. The stock would also seem to be earning back the costs in about 7 years, which is a very low figure. The screener made me buy a lot of oil and gas stocks last week, and I'm now 50% invested in oil and gas. This should even out as we buy the next stocks on lists. It's just that now, oil and gas stocks are really undervalued. Pembina is an oil and gas pipeline and storage network in Canada. Well, the company operates that network. And unlike most companies like this, it's not a limited partnership, which means that the company itself is taxed before paying out dividends. The dividend, therefore, is a bit lower than the other two midline infrastructure stocks in our portfolio, MLPX and Enterprise Product Partners, but the taxation is completely different. It will be taxed at a lower rate. The company generates its revenues by charging oil and gas companies the use of their networks. So it's kind of a recurring income, and also the cost of the network usage is not linked to the actual oil price. Oil price dropped heavily today, and it had a little effect on the stock price of Pembina, so it opened almost 5% lower, but it immediately regained the losses of the morning, even though the oil price is still more than 40% down, and it has been down more than 80% since the start of the global pandemic. And why has the oil price crashed? Why did the price drop? It's very simple. There's just no demand for oil and gas right now. Even though Russia and Saudi Arabia tried to limit their oil output, the price stayed low and kept dropping. It did not really help. There's just no demand to soak up the oil. This does have a little effect on the price of companies that are transporting and storing oil, but they are luckily still receiving fees from whatever is still being transported and stored. So not all their income has been lost. And also the value of the company is still dependent on the infrastructure they are maintaining. So we can be sure that infrastructure will bring more future earnings. Well, not more, but at least restored future earnings. Once the global economy restarts and there's a renewed production of oil. We only have to hope this doesn't take too long, but Pembina has a good debt to equity ratio, so they are still in the position to borrow more money, and they just added a credit line of $800 million to ensure their survival of this downturn. Despite the economic turmoil, Mr. Market is doing strange things. Our stocks we bought last week are already up. And even though this morning the value from Pembina dropped 5%, and we were lucky to be able to buy that dip, it restored a few hours later to the same levels as yesterday. We already even see a small gain, so we were very lucky to be able to buy at a 5% discount. Placing the order at our broker was again very straightforward. We bought 3 shares. It's a little bit more than our $50 commitment, so we wanted to buy $50, but we could not buy fractional shares for the stock. That's why I bought 3 of them, so a little more than $50, but that's okay. So even though demand for oil is dropping, the demand for stock in oil and gas related businesses is rising. At the end of the day, the small portfolio of almost $300 invested showed a gain of almost $20. That's a gain of almost 6%, and with a 6% future yield, unless of course the companies start to cut their dividend, which I hope doesn't happen because they have good balance sheets. I'm in a good way. I think I made a good start. Let me know in the comments if you would change something. What would be your advice? Thank you very much.